Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BRINKS CO quarterly report. The BRINKS company offers a wide range of services including cash and valuables management, digital retail solutions, ATM managed services, armored vehicle transportation of valuables, cash management services, counting, sorting, wrapping, etc., vaulting services for banks, transportation services for various high-value items, diamonds, jewelry, securities, etc., commercial security and payment services, guarding services, customs clearance, and secure vault storage inventory management. These services cater to a variety of clients, including financial institutions, retailers, government agencies, mints, jewelers, and other commercial operations. The recent increase in BRINKS CO stock price can be attributed to several key events over the past year. Notably, strong quarterly earnings reports have driven the stock upwards, with each quarter exceeding analyst expectations for revenue and highlighting record margins. The company's third quarter results saw a 6% year-over-year revenue increase and a 28% rise in non-GAAP EPS, while second quarter results beat forecasts by 10.49%. Additionally, strategic initiatives such as the investment in KAL ATM software have contributed to the stock's growth. These positive developments have led to notable increases in the stock price, with the company's shares rising by up to 8.88% over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by organic increases in North America, Europe, Latin America, and rest of world regions, totaling $130.6 million. Additionally, favorable currency exchange rates contributed $12.8 million to revenue growth. Acquisitions also played a role, adding $4.8 million to revenue. On the other hand, revenue decline is primarily driven by unfavorable impact of currency exchange rates, which resulted in a loss of $70.1 million. Other factors contributing to decline include lower volumes and security losses, as well as the highly inflationary impact of Argentina's economy. Transformation initiatives also had a negative impact on revenue, totaling $40.1 million. Overall, geographic expansion and favorable currency exchange rates were key drivers of revenue growth, while unfavorable currency fluctuations and economic conditions in certain regions contributed to decline. Net income and profit margins have shown significant improvement over the past year. In Q3 2025, net income increased by $5.7 million, while operating profit margin rose by 2.6 percentage points to 11.4%. Year-to-date YTD 2025 saw a similar trend, with net income up by $5 million and operating profit margin improving by 1.3 percentage points to 10.5%. These increases indicate a strengthening financial performance, driven by improved operational efficiency and potentially increased revenue streams. The company has demonstrated a substantial improvement in its operating cash flow over the past year. In 2025, net cash provided by operating activities reached $265.9 million, a notable increase from $56.2 million in 2024. Furthermore, the total operating cash flow for 2025 stands at $1,234 million, indicating a significant and sustained positive trend. This suggests that the company is generating sufficient cash to meet its operational needs, positioning it for continued growth and stability. The company's debt level and interest expenses have shown a slight increase over the past year. The total debt has risen by $94.8 million, from $3,896.2 million to $3,991 million. Similarly, interest expenses have increased by $2 million, with GAAP interest expenses rising from $63 million in 2024 to $63.4 million in the first 3 months of 2025. And from $175.3 million to $181.8 million for the 9-month period ending September 30, 2025. These increases indicate a moderate rise in debt level and interest expenses, but not significantly impactful on the company's financials. Management is optimistic about the company's outlook despite facing challenges. They aim to manage debt through various financing agreements while maintaining compliance with financial covenants. To improve profitability, they will focus on cost and operational improvements, mitigate risks associated with changing economic conditions, and invest in information technology (IT) to drive revenue growth. The company expects to meet its liquidity needs for the next 12 months, but may require additional funding thereafter. Acquisitions and divestitures overview. The company has made significant acquisitions in the past year, with a total value of $203.3 million across various regions, including North America, Latin America, Europe, and rest of world. These acquisitions have had a favorable impact on revenues, with notable contributions from Latin America, $2.8 million, and Europe, $2 million. However, the company has also incurred significant amortization expenses for acquisition-related intangible assets, totaling $44 million in the 9 months ended September 2025. On the other hand, the company has made divestitures, including the cessation of support for its Venezuela business in April 2019. Additionally, it has faced various non-routine charges, such as a highly inflationary impact in Argentina, $14.7 million, DOJ/FinCEN investigation, $5.5 million, Chile antitrust matter, $0.6 million, and non-routine auto loss matter, $1 million. The company's financial summary reveals that it has engaged in 2 key shareholder return strategies. Firstly, the company has a history of paying dividends to its shareholders, as evidenced by references on multiple pages of the document. Secondly, the company has also invested in share buybacks, further demonstrating its commitment to returning value to its investors. That concludes the financial summary for BRINKS CO. Feel free to comment below, and I will be happy to answer them when possible.